What is equity and gain? Equity and gain are both important to an exchange, but they are never the same number. Let's take a cursory look at how you determine both equity and gain. First, equity represents that hard-earned value that's yours in any property you own. So if you take your gross selling price and subtract your closing expenses or closing costs, and then further subtract the amount of any debt, that remaining number which is left over will be your equity. Now how about capital gain? Well, in order to determine gain, we need to know what is called your cost basis. And your cost basis is going to be informed by when you bought the property. So when you bought the property, you had a purchase price, correct? Well, that will be the start of your cost basis calculation, which actually changes over time. For instance, if you've done any improvements to the property, that amount should be added. And likewise, if you deducted any depreciation while you've owned the property, that will be subtracted. Therefore, let's determine your cost basis and gain this way. Let's find our final cost basis or adjusted basis. That'll be our original purchase price, plus any improvements, and then less any depreciation. That gives us our final adjusted basis. Now let's once again take that net selling price from our sale, deduct our final adjusted basis, and bingo, that is our capital gain. One last thing. Here is a very simple rule that works in exchanges if you want to have a totally tax-free transaction. And that is, do these two things and your exchange should be tax-free. Number one, buy a replacement property that is of equal or greater value than your net selling price of your relinquished property. And two, move all your equity from the old property into the new one. If you do those two things, you'll be golden.